When companies are trading stocks every day on Wall Street, how is the tracking of the share prices done and how is it calculated? Is the valuation done through PE, DCF, or some other manner? Yeah. So in terms of what the price is set at, the price of anything in the world is set by the last purchase price done. So if you ever want to sell something used on eBay, you go and look to see what products have sold on eBay to see what the last price was for that product that got sold. And sometimes one data point doesn't make a trend. Sometimes you have to look at 2 or 3 or 4 more products that are sold and calculate the average price before listing your product you want to sell on eBay, for example. By the same token, on the stock market, the last price that somebody was willing to sell their shares for, meaning someone else purchased, that last price is what sets the price for that company. Yeah. And if a company is materially undervalued, then there's an arbitrage opportunity. And sophisticated investors make sure that it's always fairly valued if possible. Now, you want to make sure that you only transact in stocks that trade a lot every day, a lot of dollars worth or money worth every day. Otherwise, you'll be a stuck holder because you'll find that illiquid stocks own you in a down market rather than vice versa. You can't get out fast enough. The bottom line is, though, that the price is always set by whatever the last price or transaction was. Yeah. And then you ask here, is evaluation done through PE, DCF, or some other manner? Yeah, I mean, it all depends because when these sophisticated investors or less sophisticated investors, depending on how much experience they have, when they value companies, they tend to use different valuation metrics. And so it all depends what kind of investor you are. If you're a value investor, meaning you like to buy stuff that's cheap, like Warren Buffett, who's brilliant, then you might look at price to book, or you might look at cash flow metrics. If you're a growth investor, like I am, meaning you like to buy expensive stocks that seem expensive today, but they're cheap based on my earnings estimates in 5 or 10 years, then you don't look at price to book. You usually look at price to earnings or price to revenue. Now, when a company goes public, what the investment bankers do is they create what's called a sales memo, along with a group of people at investment banks called Equity Capital Markets, or ECM. And in that sales memo is a summary of the deal, the company going public. And the salespeople that work on a trading floor will read that sales memo. And usually on the front page of that sales memo, there's reasons why your customers should buy that stock, along with some risks. And there's also usually 3 different valuation methodologies to value the company. Quite often they use DCF, which I don't like, but they use it because the reason I don't like it is there's a lot of unknown variables. And yeah, if I tell you X plus 1 is 3, then X is 2. If I tell you X plus 1 plus Q plus W plus P plus remote control plus microphone, whatever I see, is 3, what is X? You have no idea because there's too many unknown variables. That's what DCF is. So they provide valuation metrics for DCF, sometimes price to earnings if they have earnings, and price to revenue, which is useful if a company does not have revenue. And then you triangulate the average target price based on those 3 aforementioned methodologies. And so a lot of people that invest in new companies, they'll look at those 3 valuation methodologies. It all depends, though, if you're a growth investor, you like to buy expensive stuff, or a value investor, you like to buy cheap stuff. There's many different ways to value companies. Yeah. And it's not that simple. Like, there's no one size fits all. Otherwise, we wouldn't need people to invest. Just computers would do all of it.